Unlocking the drivers of value. In this section, we're going to talk about what drives value of a business, how to increase it, or what destroys value. We can start by looking at the formula for the net present value of a business. The present value of a business is equal to the free cash flow times 1 plus a growth rate, divided by the cost of capital minus that growth rate. So the free cash flow is the free cash flow generated by the business in this terminal year. The growth rate is the perpetual growth rate that we expect the business to grow at forever, if that were theoretically possible. And the cost of capital is the opportunity cost of investing in the firm, or it's another way to put it is the rate of return that's demanded by investors for this firm given its level of risk. So let's break apart this formula and look at the drivers of valuation. On the free cash flow part of this, we have things like business strategy, sales, marketing, cost structure, competitive advantage, business model. These things all drive cash flow of the business. To the extent we can increase sales and decrease costs, we improve the free cash flow. As free cash flow goes up, the net present value of the business goes up. On the next part of the numerator, we have the growth rate. What is the organic, sustainable growth rate of this business? When will it reach maturity, or has it already reached maturity? To the extent the business can increase this perpetual growth rate, it creates value for the company and increases its present value. On the denominator, we've got the cost of capital. The cost of capital is dependent on the risk of the business and macroeconomic factors. So as a company is able to become lower risk, either by having more stable cash flow or more stable price returns, it has a lower discount rate and therefore it increases the present value of that business. The other thing that can impact this is macroeconomic factors. Cost of capital is essentially a spread. It's a risk spread relative to the risk-free rate. So as the risk-free rate goes up, the value of a business goes down because it's a higher discount rate. As we're in a very, very low interest rate environment, that creates higher asset prices. So the economic impact of the Fed lowering rates causes asset prices to rise, as you can see in this equation. And then again, we've got the growth rate on the denominator as well. So the same impacts as described above would also apply to the growth rate on the denominator. Let's look at the drivers of value and price in a little more detail. Intrinsic value is driven by things like EBITDA, expected growth, capital requirements of the business, and the company's cost of capital, as we discussed in the previous section. But we also have to consider, in corporate finance, and particularly with acquisitions, the transaction structure. It's not just the intrinsic value of the business that matters, but also how the deal is structured. What's the form of consideration? Is it cash or shares? All of these factors listed here will play into the value versus price equation of an acquisition. And in this third category, we've got synergies and strategic value. One thing may be the intrinsic value of the business or the structure, but another is, what is the strategic value of this business to us? Does it give us diversification or entry into a new market? Maybe it's human talent that we're after, like management and employees, things that are a little harder to value in a financial model. All of these play in to the value versus price equation. And the value versus price equation also has to consider things like deal costs and process, negotiation, structuring, legal, etc. So at the end of the day, when looking at an acquisition, all four of these categories are having an impact. We've got external factors like the industry and what's happening there, and then internal factors like what's happening at the company. At the end of the day, all four converge. All four push inward to create the price that we're willing to pay, the price that creates value for us, and ultimately the price that we want to move forward with this transaction at.